What's up, y'all? It's Tutorial Paul, and we're back with some more information. Still keeping it simple. Um, Today, I want to help you guys to identify what to look for. There are so many different ways to trade that it works, but as stated before, we're keeping things simple, not going into much strategy as far as the complicated things, triple and quadruple confluences. We're going to just keep it simple. Today, we're talking about market structure and the importance of market structure when it comes time to trade. All right, so what we're going to talk about first, talk about two things: how to identify when the market is trending, and how to identify when the trend is getting ready to change. All right, so when you have both of these scenarios, you have two different perspectives. For trending, you have the bullish trend and you have the bearish trend. Bullish trend is the uptrend. Bearish trend is the downtrend. For as far as the trend change, you have two different perspectives. You have it from when the trend changes from bulls to bears, which means it's trending from an uptrend to a downtrend, and then you have when it changes from bears to bulls, when it changes from a downtrend to an uptrend. Not going to talk too much about ranging markets. I personally try my best to avoid ranging markets because they always go back to trending. So for the first uh, perspective, first topic, we're going to talk about trending markets, and we're going to talk about bullish trends or uptrends. All right, what defines bullish trends? Well, obviously higher highs and higher lows. Higher highs and higher lows, okay? Depending on what time frame you're on, you'll be able to see clearly. Let's look at the 15-minute because most people trade on the 15-minute time frame. Okay, what would be considered a higher high or higher low? Well, you have to start somewhere. All right, let's just look at where we are August 21st. Okay, the way I look at it is I look at the highest point before the market went in the opposite direction. All right, so this will be a high. Okay, this will be a low. So you have to establish those 2 points. You have to establish a high and a low. Now, ultimately, what you're looking for is a higher high, which they gave you that. It broke through that, gave you a higher high, came back and gave you a higher low. How do I know it's a higher low? Well, it's lower than this. Okay, it's a higher low because at that same point, price takes off. Now, before you see that happen, you normally wouldn't be able to. Even this technically is a higher high. It is a higher high, and this could be a higher low, definitely. All right, that would be the entry. That would be my entry for this trade. Higher highs and higher lows. What you can see is an ascending triangle. You have higher highs and consistent. You have higher lows. Forgive me. Higher lows with consistent highs. Okay, then it breaks up. Now that's that. You have another higher high. Yes, we have this high. We have a higher low. Yes. Boom. Then we go into this range. Price pulls back. And that's the thing about, what we traded with gold. Price will pull back, to one of these previous higher lows, which at this point, before they pull back, these were higher highs. So it could pull back to any one of these portions, these points, and because it is an uptrend, it still will be considered a higher high, a higher low. Okay, higher lows, and then it came back and filled this gap, came all the way back down here, filled this gap from this move that happened from this high. So it pushed up, gave us this gap between these two portions, between this low, between this low All right. All right. So it came back and filled this gap just to continue to the upside. All right. So this would be considered a range. From this point, from here to here, this market was ranging. It ranged. All right. It ranged, came back, touched, gave us a higher low, even though in this sequence of lows, it appeared to be a lower low. But if you would go to the H1, it will be a higher low. You got a fair value gap. A fair value gap is when you have, if you look at three candles, the beginning candle, the biggest candle, and that third candle. Whenever you have the A, like say for instance, A, B, C candle, A, B, and C, those three, when the A and C candles they can't touch as far as how long they are, that is what's called a fair value gap. Very simple term, but it helps. It helps a lot. All right, when you had, this was a higher low. You had a high, a low, higher, higher low. Now we know we're trending. Okay, even in this, it still breaks, gave us a higher low. Still gives us a higher low with the higher high, higher low, higher high. Okay, now we're getting into that range again where you can't really tell what's going on. The safest thing to do is to wait to see where price goes. All right, so we talked about the higher highs and higher lows. Now I'm going to talk to the trend change perspective, and because we're coming out of a bullish market, I'm going to talk about what to look for when you're trying to determine if the trend is turning from a uptrend to a downtrend. One of the main things that you will see when an uptrend turns into a downtrend is that these higher lows will become lower highs. So like this, for example, this was a higher low. Compared to this from left to right, it was a higher low. But as you see what happens as the trend changes, it becomes a lower high. Okay, even in this one, it became a lower high. So that is the difference. That's knowing when to sell and not necessarily just buy. Knowing when to sell because the trend is changing. Now this would be a head and shoulder pattern, but for those who are not that equipped or not that advanced, market structure is enough. You might not be able to trade until you get this. Okay, that's still safe. That's better safe than sorry. All right, so now as you can see, if I go down to the 15-minute, September 4th, see what we got here. All right, now we have we're in a bearish trend, which is a downtrend, and that results from lower lows turning into lower highs. One thing that I wanted to also mention, with these different trends is that your entry on the bullish trend, your entry should be from the higher low. Okay, you should be getting in at a higher low position. For the bearish trend, your entry for the sell should be off a lower high. Okay, you should be seeing a lower low forming a lower high. All right, now lower low, lower high, lower low, lower high. Your entry should never be in a place where you don't have that consistency. Okay, you shouldn't be looking to buy in a downtrend. Yes, there will be opportunities to buy, but that's not the overall move. Lower lows, lower highs. Okay, you're not gonna always get the perfect lower low and the perfect lower high situation. As you can see with this latest line I just drew, it gave you a lower low, and then it went straight across and It gave you that, but it spiked up. Okay, so now just keeping in mind risk management. What I've been doing, and it's been working very good, very phenomenally with gold. Everybody doesn't trade gold, but I like the challenge, and I've not mastered it yet, but I've learned how to make it work for me. Is even with these setups, I still trade with so whatever my capital is, I divide it by 200 to get my lot size. So, and it's very tempting because you can see a good setup and you want to go in and trade by dividing your capital by 100 because you feel like it'll get you a better position. But the only thing with gold is you got to look at the stop hunt, look at the pullbacks, and even with having it right, if you have a trade that's too big, it can come against you depending on what the market does. So what I've been doing, even though it feels like it doesn't make sense right now, long term is helping to develop the right discipline and the right money management, risk management, so that I don't have to put myself in a position to doubt the trade that I've taken because of how much money or how big of a trade that I've taken. It doesn't make sense to put yourself under unnecessary stress because you don't want to give yourself time to build your account. If you can build your account, build it, but don't rush the process. Don't rush the process. Okay, so we got that. Now we coming into a range. How do I know we coming into a range? Well, I don't know at this moment, but I know I see a low, I see a higher low, I see a higher a low, a lower high, a higher low, and then ultimately I'm looking to see what happens when price comes back to a previous low, which it did. It did, and it ultimately gave me what I already had coming. It gave me some higher lows, and then we go into these 2 days of range where it still panned out. It gave you a high, gave you a higher low, broke this high, gave you a lower high. No, this would be a higher low, which that could have been a trade, right? Took that down, gave you a higher low, pulled back up. It's still ranging, and anybody who's trading this setup is taking a chance on their account. They don't know what to do. You're getting spikes to the upside, whereas especially with people who trade only the 15-minute chart, you won't see a lot of things. So for me, I tend to go out to the 100 to the forgive me to the hour 1 hour chart because you will see more clearly that these trades are still good. The moving averages are not crossing the faster moving averages under the slower moving average, which is a good sign. Um, as far as continuations and down to, and trades to the downside. But ultimately, you're still in a range. If anything, you're taking sales. You're looking for sales, not looking for buys. And even though they may show up, it's still a seller's market. So now let's just keep it on a 1 hour chart because it's easier for you to see what I'm about to say. When you have lows that are broken, you want to wait until price comes back to that area to give you a higher low. You have a lower low. The entry for a sell trade should be a higher low. It should not be something in this. You should not be trading lower lows. And if you're looking for trades, you should not be trading lower lows until they become higher lows, which means price has broken through a lower low, pull back to retest that level, and ultimately to continue down. That is the goal. Okay. Um, and then as far as like I said before, trend changing. When the market changes from bears to bulls, you'll see lower highs turn into higher lows. All right, so let's look at what we got. We got lower high here, we got a lower high here, we got a lower high here and here. All right. So let's go to the 15-minute chart and look at September 14th to see if we can see it in more detail, which I'm pretty sure we will see it in more detail. All right, so you're looking for the trend to change from downtrend to the uptrend. We want to see a higher high, a lower high turn into a higher low. All right, at one point from left to right, this was a lower high. Well, how would I know that? Well, before price pulled back up to this, it had a low. low, boom. And in a downtrend, lower lows turn into lower highs. So this was a lower high. Now, if we're going from left to right from this point on, we will see how this point became, this lower high became a higher low, and ultimately was a good trade to enter for the trade to change. You had 3 days of continuation. You had So now went from bears to bulls, uptrend to the downtrend. Here's a higher high. Higher low is broken. No retest. Okay, let's look for the next higher high. Higher high. That's broken. Gave us a retest. Now, one thing I want to say is that every higher, when you're looking in the uptrend, every higher high will not be retested. Every in the downtrend, every lower low will not be retested for entry. So you want to make sure that you're watching and not just assuming that it's going to come back down to where you want it to be. All right. That's not how we trade. We don't want to assume. We want to watch and see. All right. We don't want to just say, well, it's got to come down. It doesn't have to come down. Just because you broke this, that doesn't mean price has to come down here. And as you can see, it didn't. All right. Now, price breaks through that. These were highs. This was a higher high. Price didn't come to that. Price breaks through that, gives you a higher low, and then go straight across. We're still in the uptrend because price broke through that, came through, kind of gave you a W. It did give us a W. We're in a higher high. We're in an uptrend situation. Moving averages have not crossed. The fast moving average is above the slow moving average. And that's why you got to understand what these numbers mean. Moving averages, the lower the moving average, the faster it goes. The higher the moving average, the slower it goes, because it covers more days. It's an average of more days. As far as let's see where we at. Okay, we're here. We got a higher high. Boom. One second. It's too much noise. Let's go check something out. Okay. All right. So we got higher high, which turns into higher lows. Let me give me this here. And this is very simple. That's the whole reason that I'm doing this. That's because I wanted to keep it simple so that you can figure out how to find yourself in this simplicity. Because it's not really that hard. A lot of times it becomes hard once you start talking about these unnecessary languages and unnecessary terms that are given to us to make us even more confused. It's real simple. Just know what you're looking for. So higher high, higher low, higher high. Remember, in an uptrend, higher highs become higher lows. Higher lows are where we enter trades in uptrends. We don't enter trades at higher highs. Okay, we don't do double tops and double bottoms, even though that's people do that. People promote that. Why don't we do double tops and double bottoms? Because in a double top or double bottom, you still don't know which way the trend is going to go. So just because you trade at a double top, does that mean that it's going to continue to go down? No, you don't have that ability to determine that. You will get it right, but if you're planning on taking this one trade and letting it ride throughout the day without putting any stops in place, without even considering the market structure, you're not trading efficiently. You're trading just off what's been said. Double tops and double bottoms are not always the best case. All right. So back to the higher highs and higher lows. Higher high, higher low, higher high, somewhat of a higher low, but throughout the day, the market comes back and tests this previous low. It breaks up, gives you a higher high, higher low, higher high. Now watch this, just in this little snippet. This higher low becomes a lower high. Price push passes it, pulls back above it, but ultimately continues down. Okay. Now, obviously, going to the bigger time frames, you'll see a lot more. It was mad divergent from here to here. Price is going down. Price is going up, and at the same time, the momentum is going down. If you want to learn more about TDIs, that's something that you can study on your own. I'm not talking about TDI at the moment, but it is a good term to learn. Okay, even if you didn't trade this, you still would have had the best option. Would have been, where am I at? The best option would have been still. Let me go back to where I was at. There we go. The best option would have been to still wait, because at the end of that day, you had an easy, even the next day, you had a real easy entry. Let's go to September 15th. Even if you didn't trade this, right? Remember, I said how higher lows become lower highs when the trend changes. When the trend change, boom, the very next day, this is a higher low. This was a higher low too. All this, higher lows, they become lower highs. So if you just took this trade and held it, that'd have been a good trade. That one trade would have put you in a good position. All right, 100, and then it did it again, gave you 3 days of the same situation. I just take this and just drag it across. Let me see, give me some. Drag it across, right? It changed here. Well, this was the second day that you could have held it. So it came down. Now we're looking at higher highs and higher lows. So this was a higher low. All right. So even with this pullback or whatever, it still gave you a higher low. Price is still going down. It gave you a little stop hunt real quick. Nice little stop hunt right there. And the thing you got to know about gold is that they do a lot of not manipulation, but they don't do like regular stops where they'll come, instead of coming here, they're coming to a lower low, a higher low that's small, but still it helps them to give more oomph to their stop hunt. So instead of them coming here, they're coming to here, right? And did it twice, ultimately continued down. Once this low is broke, you didn't have any pullback to this. Okay, I'm still in. If I take this trade, I'm still in this trade. I'm not exiting this trade. Okay, here's another low. Price came back to that. All right, so you get that, you exit it when it come again, and then you get back in with another trade because it came back, it broke it came back to that low. All right, this low was broken. Same thing. It broke it, came back to it. It's a trade. This low was broken. It broke it, came back to it twice, and then it dropped off. These are very simple situations that you don't have to be a genius to know. You just got to know what you're looking for. Why would I consider this? Every time I see a green, that is a green followed by a red. The previous red candle to me is a lower low. All right, so looking at this was the lowest low before we get to this low. All right, so this was the lowest low of the day. This was the higher low before this low, and price came right back to that low, and then ultimately pushed down, and then it did it again in this same range, came back up to this point. We just keeping it simple, not making nothing crazy, keeping it simple. This is how you find higher lows and higher highs. You name it. This is how you find it. Just looking. That's a low. Price comes through, breaks that low, retests it real quick, and continues down. It continues to go down. All right, until you get the range. You get the range, and then if you're looking for a trend to change, you want to see a lower high becomes a higher low. All right, a lot of these they didn't give you that until you got to like right here. This was a lower high, higher low, lower high, lower low. But then both of these became higher lows. This lower high became a higher low for entry, and it was game over from that trend change, and they've been going up ever since. So that's really all today. I'm not going to go over the repetition stuff of it. It's very straightforward and simple. Higher highs and higher lows, uptrend, which is the bullish trend, lower lows and lower highs, bearish trend. In a bullish trend, you want to enter off higher lows. In a bearish trend, you want to enter off lower highs. When the trend is changing from bulls to bears, from uptrend to downtrend, you want to enter at a lower high. And when the trend is changing from the bears to the bulls, from the downtrend to the uptrend, you want to enter off a higher low. All right, I hope this helps you guys. If you like it, please subscribe to my channel. I'll be keeping it simple because this is the only way that I know how to trade. It's been working. I've been doing some great things with this ideology and perspective. So if you need any type of help, please watch these videos over and over again. Just keeping it simple. I think this is like day 5. So I'll be uploading these videos talking about the same things over and over again so that you can get them down packed and hopefully change your trading career. But that's all for now. You guys have a great day.